Hi there, I'm Edward Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. If you've been following my tech series, you know the drill. And if you're new here, welcome to the club. Today, we're going to break down Meta stock using the 5 key factors to form an opinion on whether Meta is undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Today, we're diving into Meta, the tech giant behind Facebook, Instagram, and WhatsApp. With a mind-blowing 3.3 billion daily active users across its family of apps. Fun fact, this is more than 1/3 of the world's population. Let's not forget Threads, which is the most significant competitor to X, formerly known as Twitter, with 275 million monthly active users compared to roughly 600 million for X. Meta controls over 20% of the $300 billion US digital ad market, and most of its revenue comes from, you guessed it, ads. Thanks to AI, Meta is improving content recommendations and showing users better targeted ads, boosting revenues without making them feel like their eyes are being held hostage. Before we dive into Meta, don't forget to give that like button a little love. And if you're new here, hit that subscribe button so you never miss out on any future content. Now let's break Meta down into our 5 key factors to figure out whether Mark Zuckerberg is reinventing Meta or just his own looks. For the first factor, we look for companies with high returns on capital deployed. Ideally, a return on invested capital and a return on equity ratio that is higher than 15%, as this gives a strong indication of financial efficiency and future profitability. Meta ticks the box on this front with a 5-year average return on invested capital ratio of 31.4% and return on equity ratio of 27.1%. These ratios have improved in the last 3 years thanks to Meta's AI-driven monetization and better ad conversion rates. Meta has also kept its expenses growing slower than revenue, boosting profit margins. The sharp drop from 2021 to 2022 was due to Meta's Reality Labs division, which oversees metaverse investments. Reality Labs lost $13.7 billion in 2022, $16.1 billion in 2023, and the losses are expected to grow to $17.4 billion for fiscal year ending 2024. Despite this, Meta has continued to grow profits from its other businesses, making the overall performance even more impressive. Next to that, we look for companies that are able to grow earnings. Meta has shown impressive growth, with revenue increasing at a compounded annual growth rate of 18.1% and earnings per share growing at a compounded annual growth rate of 28.5% over the past 5 years. This has driven earnings per share from $6.4 in 2019 to $21.1 for fiscal year 2024. The question is whether Meta will be able to continue this trend with heavy capital expenditures in AI infrastructure and development. Their 2024 full-year capital expenditures are guided by management to be between $38 to $40 billion, with significant capital expenditure growth in 2025. In their latest earnings call, Mr. Zuckerberg mentioned that improvements in their AI-driven feed and video recommendations have led to an 8% increase in time spent on Facebook and a 6% increase on Instagram in 2024. More than 1 million advertisers use Meta's Gen AI tools, and the businesses that use this are seeing a 7% increase in conversions. This higher conversion also resulted in increased ad prices of 11% year over year. My view is that this is a really strong growth lever for Meta, as more than 10 million companies advertise on Meta. With Advantage Plus, which is Meta's ad management tool driven by AI, companies can eliminate the manual steps of ad creation and test up to 150 creative combinations that are AI generated and select the best performing ad. Another potential growth lever is Threads, with 275 million monthly active users, which has introduced advertising this month. Susan Lee, the CFO of Meta, mentioned that this will not be a meaningful driver of 2025 revenue, but I believe this could be a growth driver in the medium term, say 3 to 5 years, as Threads could attract advertisers from X at a time when the platform has undergone a drastic change under Elon Musk. Meta does not break down its revenues by individual apps. However, based on analyst estimates, Facebook contributes 40 to 50% of total revenues. Instagram accounts for 30 to 40%, and WhatsApp and Messenger bring in 10 to 15%. And there are negligible revenues from Reality Labs. Instagram's growth is strong, and it's expected to surpass Facebook in ad revenue share in the next few years. For the third factor, we look at healthy financials. Meta has a total debt of $49 billion and $71 billion in cash and short-term investments, which is rock solid as Meta can easily pay down its debt with the existing cash and short-term investments. Meta's debt has been increasing since 2019 from roughly $10 billion to $49 billion in 2024 due to heavy investments in the metaverse and in AI infrastructure. Cash and short-term investments have been hovering in the range of $40 to $71 billion, with debt in 2024 growing stronger than the increase in cash and short-term investments when compared to 2023. This is worth keeping an eye on as Meta's AI and metaverse ambitions could result in a weakening capital position. Meta, compared to peers such as Microsoft, Apple, and Alphabet, has had lower PE ratios in 2021 and 2022, driven by investor concerns over its metaverse investments. These concerns were justified, as Meta has incurred over $58 billion of losses since 2020. With a current price-to-earnings ratio of nearly 29, Meta is fair valued compared to the broader market, with a PE ratio of 29.5 for the S&P 500, which consists of the 500 largest US firms. Using the rule of thumb that I've learned from the super investor Peter Lynch, when earnings growth is higher than the price-to-earnings ratio, then this is a good indicator that the stock is undervalued. This does not appear to be the case, as the compounded annual growth rate in earnings per share for Meta is 28.5%, which is in line with the PE ratio of almost 29. However, the price paid today could be justified by future growth in ad revenues from increased monetization efficiency through artificial intelligence and the monetization of Threads. Threads is growing by 1 million monthly active users daily and could reach 500 million by the end of 2025, which is a conservative estimate given its current 275 million users. The average revenue per user across the family of apps is $45, but considering lower user engagement on Threads, we'll apply a 50% haircut, estimating an additional $11 billion in revenue for 2026. With Meta's 35.5% net profit margin, this could add around $4 billion in net income, which is exciting but not groundbreaking compared to Meta's $55 billion in net income over the past 12 months. A strong determinant of future growth is the moat. It helps protect long-term profits and market share from competition. Meta's moat is strong thanks to its massive user base across the family of apps, giving it a data collection and ad targeting advantage that even Google can't match. Some argue that Meta's moat is largely driven from social network effects, where the value of its platforms increases as more people use them. While this is certainly beneficial, I don't believe it's the key element of Meta's moat. Competitors like TikTok, Snapchat, and Pinterest have quickly built large user bases, yet they are not nearly as profitable as Meta. I think the real secret is Meta's management team, led by Mark Zuckerberg. He has 13.5% of all shares and 61% voting power, which means he can steer the ship however he likes. While that might sound like a recipe for disaster, it actually keeps the company's long-term interests in check. However, it does come with a downside. Zuckerberg's personal vision, like the ongoing investments in the metaverse, has raised some eyebrows. The metaverse isn't exactly turning a profit, leading some to wonder if it's the right play. When it comes to execution, Meta has been on point. Do you remember when Snapchat introduced stories? Meta wasn't having any of that, launching Instagram stories shortly after. Then TikTok popularized short-form videos, and Instagram responded with Reels, which now boasts 2 billion users, outpacing TikTok with 1 billion users. Meta sacrificed some short-term earnings for these innovations, which isn't always easy for hired CEOs, but it works well for founders with a long-term vision. That said, Meta isn't bulletproof. The European Union is already cracking down on AI due to privacy concerns. And with AI becoming a bigger part of Meta's business, there's a risk that more regulations could eat into profit margins. Since Europe accounts for 20 to 25% of Meta's revenue, that's something to keep an eye on. Now, before we conclude on Meta, you may have spotted in the charts in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. To conclude, in my view, Meta is fair valued based on the 5 key factors that we discussed. Meta is a robust tech firm with high returns on capital deployed, which has been growing in the last 3 years due to strong execution by management. Earnings are growing strong, with their largest source of profits coming from advertising revenues from their family of apps. In my view, this trend will continue as they are investing heavily in AI infrastructure, which will further improve their monetization efficiency. From a valuation perspective, the stock seems to be fair valued based on the current valuation. When you factor in the growth prospects from AI and threads, the stock still looks fair value to me, as heavy investments in AI are needed to achieve this growth, and monetization of threads will take a few years as improvements are needed in user engagement. Meta has a very strong moat through the execution power of management and their relentless focus on moving and learning faster than their competitors. Also, the long-term interest of management and shareholders is strongly aligned, with Mark Zuckerberg owning 13.5% of Meta. Please let me know in the comments below what your view is on the valuation of Meta, or if you would like me to analyze another company. Thank you for watching and see you next time.